Welcome to the Big Brain Podcast. I'm your co-host, Larry Cermak. I'm joined by Namik, CSO of MegaETH. And today we have a special guest, Tarun Chitra, CEO of Gauntlet. So welcome, Tarun.
Hey, excited to be here.
Tarun, you've been sort of dominating my Twitter feed for the last...
I'm sorry. I don't think I was trying.
But I think I'm not on Twitter as much anymore, but whenever I opened the app, it was like Tarun Dan. So we want to discuss some of that, obviously. You published a big paper on ADL and on some of the situation with Hyperliquid and a little bit about other exchanges as well. So we'll talk about that. But before we get into that, it would be great, Tarun, if you can kind of give us an overview of how you even got into crypto, why you are still in crypto after so many years, and then we'll kind of ease into other topics and talk about the paper and disagreements.
Yeah, sounds good. Cool. So yeah, I have full time been in crypto since 2018. But my first exposure was sort of like 2012, 2013. I was working in ASIC development, hardware development, and long story short, my first employer we had a chip order out in Taiwan, and then the chip manufacturer ghosted us for 6 months after we gave them money, and then it turned out it was because like some Bitcoin miner front run us to buy the chip space. So I was like, if people are willing to do this, I should be mining some. So I tried, and I did, and then I stupidly sold it all in 2014. So yeah, but that was my first exposure. And then sort of 2018, kind of one thing I found interesting about the ICO boom, which is sort of interesting in the sense that like it was a crypto boom driven by research papers, which I don't think is true that much anymore. But was that a lot of the research people were focused on was like advanced cryptography, distributed systems. But then the economics were like, made no sense. It would be like, we have a blockchain that's going to have 10,000 times the throughput of Ethereum, but we're going to copy Ethereum's block rewards. And it's like, wait, didn't you just tell me you increased the supply 10,000 times? Are you sure you want to do the same exact economics? So that's sort of what led me down the road of writing papers and research, starting Gauntlet, and then Robot Ventures in 2020 of like, hey, there's a lot of stuff in crypto where there's what's the phrase? In every good lie, there's a kernel of truth. And in every kind of good marketing, there is still a kernel of truth, right? So like I think a lot of the stuff that was marketed in crypto in 2017, 2018, most of it went to zero, right? But the stuff that survived was stuff like DeFi, right? Like at that time, the way people, talked about new metas like perps dexes or whatever stablecoin neobanks or L2s right? Like I would argue that the first time I ever really saw that happen and then it was super successful was probably L1s in 2016 and then DeFi ICO boom, right? Like those were two where like there were huge amounts of capital raised. Most projects went to zero, but like the one or two that survived were real innovations. So the question is like, can you figure out ways of analyzing those so that they're less risky or like safer to use? And so that's sort of been my bent and kind of how I end up writing a lot of research over the years. And probably how I got myself into this controversy, although I think maybe there's a perfect storm of timing for this.
It's interesting. You're clearly being very humble, right? Full disclosure, right? Tarun's an investor in MegaETH, but the vast majority of people I've spoken to about MegaETH, they're always just really interested in like Mega is a very pragmatic solution, right? Good business sense, whatnot. But Tarun would nerd out around all of these like technical innovations that I didn't even know about, right? So, like, what is your formal education, right? How are you able to get so deep and nuanced when it comes to like research, be it research you write yourself or the ability to kind of understand the landscape and analyze it?
Yeah, so I sort of have a weird background in that I did an undergrad in sort of like math and theoretical physics. And I was going to do a PhD in sort of theoretical physics, but like sort of more on the math side. And then I got this job that was like, hey, work here for 2 years and go back and do your PhD in 2010. That was a place called DE Shaw Research. And there they were building ASICs for doing protein folding. So there's a sense in which my old employer succeeded in that they were able to successfully do protein folding, but there's also a sense in which they failed in that, the person who won the Nobel Prize for it was from Google. But the more interesting thing is that one of the two people who won the Nobel Prize was my first boss. So I think like that place was a very unique environment. There's also someone else in crypto who worked at the same place for many years, which is Kevin Bowers, who made the Fire Dancer client for Solana. And so that place was a very unique mixture of people who are thinking in terms of like applied math, people thinking in terms of hardware, and people thinking in terms of physics. Because like to simulate proteins, you need to really understand the physics. And eventually there were biologists, but like I would say it was kind of an interdisciplinary research space. And the cool thing about that was like you'd go there and like you just learn about some field that wasn't yours, but like have experts around and like had this kind of collegial mixing. And I think probably like crypto in 2018 to 2021, I think a lot of the research that was successful was like from people with non-standard backgrounds, right? Like people who weren't like cryptographers or distributed systems, right? Like DeFi research came out of people who were like, there was no notion of what an expert in DeFi was, right? And so I think having kind of mixed non-standard backgrounds where you've been able to learn a bunch of things is more important than being highly specialized in learning one thing, which I think, the places where that has benefited the most has been AI, crypto, like places where there's like a lot of different things at play, right? Like in crypto, you have a technology aspect, you have a social aspect, and you have a market dynamics aspect, right? And those three things are all kind of different. And if you really know one of them, it doesn't necessarily mean you'll be able to think about the whole system. And so I just think from my perspective is like I was just naturally interested in reading a lot of the papers. I think because I'd worked in hardware, and I had just been initially very skeptical of Bitcoin because like the original Bitcoin white paper kind of like leaves 5 million details unanswered, right? Like that when you implement it, you probably would figure it out. And I think, at that time, no one working in distributed systems really took it very seriously. They just kind of didn't think it worked because no one really figured out the correct reason. And I think it took until like 2014 or 2015 for like the first sort of rigorous research that, I think you can argue a lot of the advances in Solana and Ethereum probably come out of that era of research. And so, yeah, I just think it's like there's some fields where it really makes sense to be like a really customized expert. And there's some fields where it's like breadth is very important. You need to learn a lot of things, and crypto just happens to be one of those. So I would say like that's sort of why it has been interesting to me over the years. I think it like ebbs and flows. There's just like times where the research, at least in the stuff I like to do, is less prescient. There's like less of it in the market. And there's times where there's more. And, I think DeFi research had this boom in 2020, 2021. And then I'd say it kind of died post FTX a little bit because like people were just, I think there was kind of this brand problem that Luna was conflated with all of DeFi for a lot of people. So they're like, no, DeFi is bad. We need to like only do zero knowledge proof research. And I think, it's kind of come back a little bit, but I think people kind of focused on the wrong things. Or they're like hoping to go back to like the Ethereum DeFi 1.0 research would keep working. And I'd argue that like the Solana DeFi people, more than any of the perp dexes, to be honest, kind of figured out a lot of the stuff that was like the real research problems to solve, even though they like maybe didn't do it formally. They did it just by trying engineering stuff. And that's kind of the beauty of crypto, right? Like sometimes a new product exists because someone like theorized an idea, wrote it down, and then, kind of analyzed it. And sometimes it's, literally someone's like, I'm going to hack this together and hope it works, right? And there's not many fields like that. Usually like the ladder to hack this together and hope it works, like doesn't really work in most places. And in crypto, you have this natural, you know, in most parts of the world, whether it's AI, whether it's the natural sciences, where you have to do experiments to figure out if something works. The experiments are expensive, but in crypto, the experiments are degens love gambling, so they're going to fund the experiment, right? They're going to deposit in the protocol. They're going to trade the token. They're going to basically pay for your experiment, which is a very different model.
Yeah, I remember there was this recording I watched somewhere of Vitalik once saying that the beauty of crypto is it helps fund small amounts of money very quickly, right? And by small amounts of money, I mean millions of dollars. I don't mean 10K. But it's not very good at pooling like billions of dollars of capital, but it can help fund experiments very quickly and very rapidly. And I guess that's kind of what you're alluding to, at least in terms of DeFi innovation. So Tarun, as Larry mentioned, there was a lot of tweets over the weekend, as well as second half of last week. You kind of came out with a research paper discussing ADLs. I'd love for you to walk us through what you were trying to uncover, what your claim was, and maybe what some of this controversy was, both between yourself and other researchers, as well as the general like trading community.
Yeah. So let's start with sort of the more like philosophical bet, which is, why did I write this? Because, if you read a lot of the tweets, it's like, this is a bag pumping paper or whatever. And if that was true, I don't need to write 95 pages. I could do that in like 2. But
few tweets.
Yeah, exactly. So like, there's some labor of love to get to a longer size. But the thing I will say is basically October 10th happened. And Gauntlet, my company, we run a lot of vault strategies and Morpho as well as perpetuals vaults. And so the thing that was very confusing to me was we had a staging vault, like a test strategy that had like $1,000, like a de minimis amount to like just test, before something goes live, you test on small money. And it had a position that had like 1.2x leverage and it was ADL'd. And it was sort of like, why did this happen? Shouldn't isn't it weird that this kind of tiny position was ADL? And then it started to make me go like, how does ADL work again? And so then I started reading the docs. And the interesting thing about what ADL is from a trader's perspective is the following. You go to a perpetuals exchange, you go to Binance, you go to Hyperliquid. You have some cash, USDC. You put it as collateral. And then you open and close positions and you have a P&L. Now, that if I think about myself being solvent, it's that my cash that I put up is worth more than my profit. Like if my negative profit is more than the cash I have, I should get liquidated. And in a normal functioning exchange, that's what happens, right? I put up $100, I lose $100 in P&L, I get liquidated. Now, adding funding rates and fees and whatever, but just simplified, that's what happens. Now, what is sort of the dual problem of that for the exchange? Well, the dual problem for the exchange is there's 100 traders, they each put up $100, and now I have $10,000. But the traders can open up positions and the total profit of all the traders can vary over time. It could be potentially all up, potentially down. But the main thing that matters to me as the exchange operator is that I always have more cash than P&L. Because if everyone calls withdraw, like give me my money back at the same time, then I should be able to pay them all out. And so that tells us a notion of solvency for an exchange. An exchange is solvent is that like every time it has more cash than it has to pay out. Like if everyone called withdraw at the same time, they all get their money back. So it's possible in rare occasions for this not to happen, where everyone's positions are all correlatedly negative and everyone has lost money at the same time. And if they all hit withdraw, they're dead. But also liquidations don't work. And why are liquidations not working? well, it's unprofitable to liquidate those positions because the price moves so fast in one direction. There's no liquidity. The slippage cost is high. That's sort of the rough idea of like, that's when this auto deleveraging ADL happens. It's this extreme rare case, although it's not as rare as people think, as we learned. So you've been used 18 times since 2020 in aggregate across all exchanges.
How many of those were in 1010 though, out of the 18?
At least 6.
Okay. Wow, that's still a lot.
Post FTX 1010, March 12th, 2020. Those were like the big ADL events.
Okay.
So like, and there was actually one in summer 2021 that was like Luna. I don't know if you guys remember. There's this like big crash where Luna went from like 80 to 30 in like a few hours, and there was an ADL event that day on Luna in particular. So, anyway, long story short, they are used. But the thing you might say is like, okay, so what is this thing doing? Well, fundamentally, an exchange, if it's insolvent, like the cash it has is less than kind of the amount it has to pay out. What it does is it has to haircut users. It has to say, take users who have positive P&L and close them out so that we can close out the negative profit. And it may turn out that there's not enough profits to totally balance, but the idea is like, I start closing them out. And then if the prices recover or liquidity recovers, then hopefully the exchange recovers solvency. And so it's like you do this in a situation that's a really last ditch effort. And the key thing is it's a socialized loss, right? It's the winners are paying the losers. Like the ones who have more negative profit than their cash are being paid by the winners. And so there's a very good blog post that came out like a week or two before I posted this paper by Arthur Hayes about the history of ADL. Like the paper is actually about something else, but it's like it's sort of his history about why the perpetual future was invented, right? And like why BitMEX sort of created the first one, and like what the story was. You know, a lot of Arthur Hayes blog posts are like maybe more talking about price a lot. This one was actually really focused on this like history, and I think it was super well written. But one thing he explains, and sort of I did some digging, and this was also the earliest reference I could find of ADL, is it sort of was created as this method that Huobi used in 2015 for dated futures, like futures that had a monthly expiry, not perpetuals. And at that time, before Huobi used this, they would just use their own balance sheet. So if they ever got in this negative condition where there was more, you know, Huobi would just say, we'll pay. But I guess they had enough of those events. So there's this weird thing that happens if the exchange pays, which is you incentivize moral hazard. You incentivize traders to take more leverage, which increases their chance of reaching this scenario if they know they're going to get paid out, right? It's like very 2008 financial crisis. And I think that's basically what happened is people started just doing more leverage because they're like, oh, well, if it goes to zero, Huobi covers it. And so then they were like, okay, to reduce this, we should actually, do more risk sharing. And so ADL sort of was invented this way. It exists in TradFi in a totally different form, which we can talk about later if you guys are interested. But basically, BitMEX 2016 added it to the perpetual future as a last resort mechanism. And when I say last resort, people assume that when ADL is triggered, it happens only once. So it's like, okay, I haircut the winners to pay off the losers' bad debt effectively. And all right, hopefully the exchange is solvent again. It was not assumed to be a thing where like it would be used repeatedly, which is what happened on 1010, where it was like used many, many times over this 5-minute period on Hyperliquid. And so one key thing to note is that centralized exchanges have implemented ADL, but obviously none of the code is open source, and the documentation on it is pretty sparse. They tell you the following, which is this is the algorithm that Huobi or Binance use, which is take all the positions you have and rank them by something. And for simplicity, I'll choose I'll use the rank that most of them use, which is they take the percent P&L, so like what your profit percentage is on your position, times your leverage. So if you earn 10% and you use 2x leverage versus someone who earned 10% but used 10x leverage, the 10x leverage person is ranked ahead. And so you get ranked in order, and then you just get haircut fully until the bad debt is realized. There's a natural sense in which this is unfair, because it says if I'm the most successful trader in some sense, obviously with some risk adjustment from the leverage, I take the brunt of the hit, right? And there have been a couple exchanges, Drift and Paradex in particular, not a huge amount of volume, but who are decentralized exchanges. And in Drift's case, the code is public, where they do a more fair sharing. They equally share the loss across all the winning traders. And so I think when 1010 happened, I just personally had this feeling of like a doomsday feeling, like post FTX. It's like, this thing is like a disastrous event, right? Like it's like disastrous in the sense that all this new money that would come to crypto is probably like afraid of coming after seeing that, because it sort of shows some brittleness in how things are broken. And Don Wilson, who's the founder of DRW, large trading firm, large crypto market maker, I don't know if he ever used Twitter before this tweet, but he tweeted on October 11th about how ADL is a bad system. It like will kind of no institutional traders from TradFi would ever use it. They'll just stick to the CME. They'll never move to perpetuals exchanges unless you have sort of this clearing system that you have in normal finance. And I read that and I was sort of a little bit kind of annoyed in some ways, because like if crypto ends up in this state where we just copy the TradFi clearing, which is like basically you have counterparties, these entities who post collateral on your behalf, and they get slashed when this ADL, like they lose money on your behalf, but you have to pay them a fee. So it's sort of like adding another middleman. If we ended up at that, that's like a kind of big loss, because it kind of means like we didn't succeed, right? The point of self-custody bearer assets is that we don't need this like because they basically have to custody your funds to do this. And so it was just a question of like, okay, this mechanism clearly right now, it's doing something wrong. It's also, funded from a theoretical CS standpoint, it's doing a greedy algorithm. It's like lining things up and just like picking them from highest to lowest. It's not doing anything more intelligent than that. Now, there's a lot of practical reasons for doing that. When you're in this case, you want to do it quickly. And so you have to choose an easy algorithm. And this is an easy to implement algorithm. But there was sort of a question I had more of the sense of, okay, assume this is really bad and we just need to figure out something better. Question one, what is the set of all the strategies? We know there's 3 strategies. We know there's strategy 1, which is I'm Huobi in 2014. I take all the losses. But then my traders are like, okay, I'm just going to take more leverage until they blow up. Bad. Number 2, the ADL that everyone uses. And it seems like everyone just kind of copied, Binance copied BitMEX, and then, basically after Binance did it, every exchange is basically copied Binance. Okay, and then the third thing is you socialize all the losses equally, right? And so then you have this question of how do you measure which one is best? Are there some scenarios like one is better than the other? And are there scenarios in which as an exchange grows, as it scales, one of these things that might work when it's small stops working when it's large? And that sort of led me down this path of like, what is fairness to traders, right? Like, what does it mean to be a fair ADL policy to traders? And, long story short, I basically wrote this paper that initially started with this theoretical analysis of like, what are conditions you want out of an ADL policy? One, is it return solvency? Like it quickly goes from insolvent to solvent. 2 is it's fair to traders. Like it's not like you're concentrating all the losses to a small number of traders, right? This queuing method that everyone uses clearly does that, right? It like ranks them from highest to lowest and like completely closes positions. And then the third is revenue maximization. So the revenue maximization one is the hardest one to define formally, and arguably that's part of the reason people are sort of also complaining, which is, did I liquidate my best traders who will never come back? Like imagine I liquidated all their profits and now they kind of don't have that capital. Well, will they come back to this exchange? or not.
So the argument would be that the system that's currently being used, right, by the Binances and the Hyperliquids, where they penalize the best traders, right? Because especially if you're optimizing for who can make the most of the least using leverage, that would be the worst revenue maximization.
Yeah, I mean, they do try to rank by like profit, P&L profit times leverage, so like it kind of compensates for it. But in a exchange where your maybe highest profit winners are like delta neutral traders who are maybe not taking as much leverage, they're sort of in the worst of both worlds because
Yep.
suppose they're trading Hyperliquid and Binance, and the highest value trader is this person who has a 50% profit, use 1.5x leverage. And then on the other side, they have a minus 49% profit and they use 1.5x leverage. And so they're sort of like in the worst of both worlds in this ranking potentially because they are ranked high. And so different exchanges have different policies and how aggressive they are. Again, you don't know the implementation and you don't actually know exactly.
And this is something I wanted to double click on as well. We had Evgeny on the podcast right after 1010, and he told us that the ADL on Binance was like particularly weird, where you just got hit on like not just without really an explanation, but also at just weird prices, where there was definitely some sort of a malfunction that was never really even disclosed by Binance. And obviously, they were dealing with Binance privately about these issues, and some of these may have been settled privately as well, right? And so I think this is one of the problems that you're also pointing out in your paper. At least with Hyperliquid, you can analyze these situations, and it's slightly more transparent. But ultimately, all these exchanges have closed source systems without really disclosing much of the information about how this works. And then we end up in a situation like this when most of the resolution actually happens behind the closed doors, and we don't really even know if Binance changed anything, or if other exchanges like Bybit, BitGet, whoever else actually changed anything. Is that something that you think like has to change for the industry to be more trustworthy and for people to trust this market a little bit more going forward? Is just to like have more information out there, or at least like have a transparent code out there that determines how these events are actually handled?
Yeah, so I think, like I was saying earlier, there are a couple examples, like Drift does have fully public ADL mechanism. And also, I've also learned that there's another army that I angered in the process, which was Paradex, although obviously not as big as the Hyperliquid army. And that's because they reserve the term ADL for only this ranking algorithm. Anything that socializes across everyone is not called ADL. And if you call it ADL, it's like a bad word for them. But I think the transparency is actually super important in a decentralized exchange, more so because it's like they're not going to pay you back, right? There's no phone call you're going to have. But I also think there's a question of like, what can you do? Like, and so I gave you those three properties: solvency, revenue, and fairness. And the main crux of the paper is it illustrates a number of different ways in which you can get 2 out of 3 of those, and tries to conclude by saying, like, under some conditions, here's a theorem, like a little bit like the blockchain trilemma. You get a sort of ADL, like you can't get all 3 perfectly. Now, a trilemma is never always fake, right? Like blockchains exist despite this trilemma. Like Larry, I know you were around when everyone was constantly talking about the blockchain trilemma and Holons in that era. And it just means that you have to find a different strategy, right? And so a lot of the paper, and this is the part of the paper that I think is correct still, is about defining the strategy space. Like, what is the space of different things you could do? Like, I can choose a ranking. I can haircut everyone equally. I can maybe haircut some traders more than others. Like, and so the paper tries to define the space of these strategies and then show some properties of these strategies. Like, under some conditions, strategies that have this type of thing, they optimize for solvency and revenue, but not fairness. Strategies that look like this optimize for fairness and revenue and not solvency. And that was sort of like the framing of the paper. Now, I think the controversy is twofold. So first, there was the .hl controversy, which was really about like, hey, like, I think I was a little more careless in the blog, but I think in the paper, kind of talk about it doesn't matter how they're like this paper is not focused on how after I choose the haircuts, how I execute them. Because that's also not public, right? Like somehow those trades have to get closed, and they might get closed directly in the exchange. They might get closed in an HLP style pool, like some type of pool that's managing the accounts. One reason it might be the HLP pool is if the HLP pool is holding the offsetting position, like every time you open a perps trade, there's implicitly an offsetting position. If it happens to hold the offsetting position, it might close it against that directly. So, and to be fair, like exactly the mechanics of that vary a lot from exchange to exchange. So I try to zoom out and not focus on that. But in the blog, I sort of mentioned one way that could happen, obviously not the way that HL uses. So people were up in arms about that. But the main point is there is not that much transparency on these. B, we haven't really said, have we explored the space of alternatives, right? We've kind of copy pasted this one thing and then a couple of small exchanges do something different. Is there anything in the middle? And most of the paper is about showing that there are things in the middle. Now, the crux of the other argument, which Dan Robinson of Paradigm pointed out in a very long thread, but I'm trying to avoid beef, so I will not say my opinion and true feelings overall.
And now you have to.
No. We had a truce on Twitter, so I'm détente, let's say. But I will say that there was a real issue that was found, which is fair but fixable, which is in my paper, I assume that the haircuts, like how much you get haircut, includes the cash. So you know how I said you rank the positions by profit and leverage? I assumed you close out the whole position. Like you close out the P&L plus you take the cash, which is not true. Like you only close out the P&L and then you return the cash to the user, right? So it's like you might have put $100 of collateral, you have a profit of 50. In the numerical analysis I did, I counted both. Now, it turns out the space of algorithms for doing the haircuts doesn't matter whether it's on the small part that's just the P&L or the thing that's the P&L plus cash. So the theoretical results can actually be fixed. The numerical results are what are probably overstated. And so I'm working on redoing the analysis of that. So I think because I had this high headline number in the blog of 650 million, that was sort of also what triggered the .HLs. And look, I'm not going to like say, oh yeah, like that was right. Obviously I need to fix it. But roughly speaking, the result is still true. Like they did over liquidate and it did it by something closer to 100 million than to 650. Now, the interesting thing is that all of these other strategies that I talked about, so different ways of haircutting, like maybe you're someone who has had high leverage for a longer time and you take more of the haircut. You've had high leverage for a short time, you take less, whatever. All of these types of strategies, there are a bunch of strategies that just do better than this greedy algorithm. And one of the reasons of the greedy thing doesn't work is if you have many ADL events in a row, like you had on October 10th, the greedy thing overshoots. And the excess it overshoots by sort of compounds in some way. Because if there's another ADL event afterwards, that means someone who was a winner before had to have flipped to be positive because there's and you, by not haircutting them then, you've now created bad debt, right? So so there's kind of this weird trade-off that goes on when you have multiple of these events. In the case where you have a single event and the exchange recovers, the thing Hobie invented and BitMEX sort of perpified is sufficient, right? Like if it's a one-time thing, it's fine. The key problem is if it happens a bunch of times. Now, there's a lot of people who would be like, well, it doesn't have to happen a bunch of times. I can change the exchange's logic. And I think Anatoly from Solana made a comment like that, which is totally true, right? But I just kind of want to bring to light two things. One, we have copy pasted something from 2015. Two, it's not super transparent at all how it's implemented, what prices are used, whether it's using the bankruptcy price, which is like the price you get liquidated at, whether it's using a price above, a price below. If you don't have the implementation, you don't know. And then third is like, hey, if we want to be better as an industry and attract people to decentralized exchanges, we should build better mechanisms, right? Like it has liquidated lots of P&L, like billions of dollars over time. And it's a question of, should we twiddle our thumbs and just pretend that the existing thing works? Not really, right? Like that's what motivated me to write this. And like, yes, there's stuff I have to fix. But I think directionally the answer is the same. It's just the magnitude is down. But overall, even after all this, I think hopefully the positive message is like, you could do better, right? And that we can improve these things while also making them more transparent. But also, like, you as a trader should be able to feel like, hey, I'm getting a better deal from this exchange, right? Like, and like that's the thing you want in the long run, right? Is you as a trader go to an exchange, you're successful, you make a lot of money, you don't have to think about these downside cases because you kind of have a verifiable way to know they're fair. And I think every tail event that happens probably, hopefully, brings people more on chain, right? That's like that to me. That's like kind of what I hope for. So anyway, I monologued for a while. You guys
Go for it, Larry.
I was just going to say, like, I think for a researcher, right, you've written like more than 10 peer-reviewed papers in crypto. You're one of the few people that actually are actively in crypto day to day and write these scientifically peer-reviewed papers. This is kind of a good thing they got so much attention, isn't it? From just like the perspective of like, well, probably a lot more people read it. Probably we wouldn't have you on this podcast if this beef didn't happen on Twitter. And therefore you're kind of accomplishing what you want, right? As a researcher, it's like bring more people to read the paper, which is kind of showing fundamental issues with the space that you're trying to fix so that we have a better future in this industry. Do you think that's right? Or do you think like there was like a little bit too much of negative attention to this? Like, do you think it's a good outcome that this happened or not?
I think the short-term pain was painful, but hopefully the long-term gain is good. You know, like, do I want this to happen every time? You know, I feel like definitely not. It was a lot. I also think there's been a bit of a tendency. I feel like since last year or something, and I don't know exactly what this is, where like research has gone from like helping improve protocols to a little bit like protecting my bags or like marketing or like, whatever, dunking on competitors. And I think I had not, as someone who's been in this space for a while, written a lot of stuff, but like didn't write that much in the last year. Did not realize like it switched so much to that it just felt like everyone just is assuming you're like writing something to like dunk on their bags or whatever. And like, that was just certainly not true 5 years ago. And like probably not true 2 years ago, but definitely feels true now. And so I think that part is a little bit hard, annoying, but like I really wasn't trying to dunk on Hyperliquid. If anything, I'm trying to argue that, hey, the fact they were transparent means you could tell this happened. In fact, I had a number of people who worked at centralized exchanges message me and tell me this cascading thing has happened in centralized exchanges before, like where multiple events happened, but people just like didn't know because there's no public data of all the ADLs. You know it if you got ADL'd, right? And like realistically, unless you're like a very large market maker and in every symbol and like you happen to have all the right positions, you had to be first place in all of the markets, you might have not seen, you might not have been able to know this happened.
I remember like how we found out about these things in the past, really with like Huobi OKX and stuff, was that there would be one really large trader who was just pissed off because he was ADL for so much money that's how you would find out. He would tweet about it. He would try to get the money back somehow. That's how you would find out. So I completely agree with you. Like at least with Hyperliquid and hopefully with Lighter and this like perp dex trend, it will give us more transparency into how these things are happening and what we can actually do to fix them. And you wouldn't be able to write this paper without this data. So like that in itself is a good contribution.
Yeah, I think like that's kind of the thing I want to leave you're not protecting my bags people is like, I'm trying to protect all the bags, right? This is not just like your fucking bag. Like at some level, there's a sense in which this is a systematic failure. And like, if you want the market to grow, you need to like Don Wilson's tweets, as much as it's like, and I have an infinite amount of respect for him because like he's just been a dominant in like so many different fields over time. But like he had a very good point, which is like, yeah, if you don't fix this, we're just going to go back to the centralized thing, right? Like that's kind of what he said, and he was just and look, DRW is one of the only two FCMs, clearing agents who like put up money for traders. It's like them and Jump, and maybe Sodal, and it's like, you know, he has incentive to tell you like, yes, we're going to go this way, but he also has very good reason from 1010 to actually push for that. And it's hard to blame him if like no one is really trying to like make this thing better. Like that, to me, that's sort of the thing I'm trying to get at. And I think for traders, from the perspective of a trader, you don't you want to trade an exchange where you know that you're treated more fairly than like, oh, like I happen to get to be the highest one liquidated, and like unless I complained enough, I like don't get paid back. Like,
Interestingly enough, I guess here's a question. Who is trying to make things better, right? So the one thing I took away from the past 30, 40 minutes is you had this one sentence, no one's exploring the middle space. There's a couple different options. No one's exploring the middle space. I have to assume someone is. Maybe it's just research, lone researcher that you've read, or, maybe it's a perp dex that's launched, or yet to be launched. Do you know anyone who's trying to innovate in this mechanism space for ADLs as a way of differentiating their product?
I certainly think when this kind of hullabaloo first started, I definitely got a lot of perp decks that I've never heard of claiming that they had solved this already. But, everyone always does that whenever there's a big event. I think there are a couple exchanges that are focused on this like full verifiability. I think Lighter, once all the circuits are released, will basically be that. I think Decibel on Aptos is like also focusing on verifiability. So like that includes the liquidation aspect and ADL aspect. There is, I'm trying to remember the name of this. I think it's called Rift. It's like a succinct, it's like a Bitcoin perp dex that's using ZK. I think they also are really focused on like the transparency aspect. And like, look, to all the .hl haters, like, assuming, Jeff gets past being angry and thinking I'm thudding him, this is not that hard it's like not that hard to pick some point in this design space that's different than what they did. Assuming like, you get comfortable enough with whatever decisions you want to do on that. So I just think it's not, I sort of restricted to like classes of algorithms that are easy, like very easy to solve, like, so you can do them quickly. Cause like there is a set, from an execution standpoint, these algorithms are sort of like need to be executed at the lowest latency possible. Like they need to be about as fast as like a couple Oracle updates at, most. And so, I think like there are people who are thinking about it, but I think like, again, everyone kind of has left this ADL thing as this like, oh, it never happens, it's rare, we pay people out. And I think in DEXs, you have the first time you really have to fundamentally care about it because there's no paying people back. I mean, it's just like, it's kind of like a system made to not do that. And so you do really have to be more careful. Now, I think there's another thing that's actually important to think about is like the role of insurance funds. Like a lot of centralized exchanges have insurance funds. Some perp dexes have insurance funds. And the question is more like, how do you pick an insurance fund that's the right size? I think in like centralized exchanges, they all have like way too big of insurance funds relative to their insolvencies. I think in perp dexes, especially in the like liquidity model where you have these liquidity providers, they're a little under collateralized on the insurance. And so like, I think the target should be like somewhere in the middle. And like, that's to me is like the simplest solution is like have slightly better insurance buffer than you have right now. I think in general, I think in the beginning when it got all this attention and it was a bloodbath, it was a little bit disheartening because I'm like, I spent 2 months doing this thing for no money or no reward. Like, it's not like I was doing this out of pure like, this seems bad if it's never fixed. Like, and we have another event like this because like, I mean, just look at Binance OI since 1010, right? It's like, it is really bad. And I guess it's another reason that the hyperliquid.hl's got angry at me, which is like, I only featured the lighter OI change. I should have also featured everyone else's OI. But you know, like I was just trying to write something to like explain the paper quickly. I should have like probably been a little better at that. But
Namik and I were talking about this before we started recording, but every cycle there are these communities like Hyperliquid, you know, like Solana one was similar. Before that, you had Luna, who obviously didn't end up well. But these communities, they're like just like so cultish that whatever you say, regardless of your intentions, you're just gonna be called bad words, and you know they're gonna like drop on your tweets and like call you retarded and all these things. Why do you think this happens so much in crypto, outside of like the obvious, which is protecting your backs? And then two, like, do you think this is actually beneficial for the community? Like, do you think this is beneficial for Hyperliquid to be kind of like proud in these tweets that they don't agree with and just like making you look dumb? Or is it just like overall, maybe it's good for them, but it's really bad for the overall crypto ecosystem because they're just like protecting themselves, but in return, they're like fucking up everyone else.
I can see two sides to this. I think the Solana one was actually extremely productive because that's what kept them alive post FTX, just like
Right.
fundamentally, is that like they had this like kind of community. I think in the Hyperliquid case, it's a little bit weird because like I feel like a lot of the reason they're so angry is just like the competitive landscape and stuff like that. And it's, I think in Solana's case, it kind of wasn't that. They like very clearly won the L1 war in 2021 and then very clearly were like went to zero, or like people marked them to zero in like a year after that. And like that huge volatility, the community was necessary to come back from. In the hype case, yeah, it is true. I do think they face more FUD than Solana. Like everyone was just like Solana's worth nothing, right? Like that was kind of the thing. Whereas here it's like there's more like competitors fudding it and whatever. And like on all sides. I feel like this perp war has a lot of that type of thing. And I don't know. I'm not sure it's like as productive as it is for an L1. Like in L1, you have an ecosystem, you know, where like if the ecosystem dies, the chain dies, right? So you do need this like, it's almost like a antibody, like an immunization. And I know I'm sure there's some anti-vaxxers going to get angry from that comparison, but it is sort of like a vaccine for you. But for perp decks, I don't know if you need a vaccine. You're making money. That's kind of the opposite of an L1, where like the reason you need the vaccine is you're broke, or like you don't, you know, you kind of need to like keep people inspired even when there's like no usage or revenue.
You know, it's weird. From my point of view, it's like I feel like I experienced the exact opposite, which is there was so much FUD for Solana last cycle, right? Nonstop, yeah, this is centralized scam, right? Like goes against all of the values of crypto, blah, blah, blah. Scam chain, right? Meme coin chain, FTX crime chain, all of these different variations. And then, you know, obviously Sol went to 8, you know, whatever, Vitalik, this, that. But my point of view of Hyperliquid is the opposite, which is everyone's always said Hyperliquid is goated. I feel like Hyperliquid's gotten so little FUD, pulled up, made everybody super rich, and it makes revenue, right? So I don't know. I feel like, yes, do the HLs need to be this aggressive? Definitely not. But I also don't think they've had it that hard relative to Solana. I don't know. What do you think, Larry? Am I tripping here?
I think you're right, but like what I think is triggering the community now is that price is just down, right? Price is down like 60% or whatever. And then secondly, competition has picked up. You have like CZs, you know, make believe exchange. It's now like printing fake values probably. You have Lighter, you know, giving out a lot of points, teasing the TGE in the future. Like, so I understand why they're a little bit aggressive, right? Because like clearly the market has not been that great, and they also have faced like quite insane competition. Just in terms of like me, and I think Tarun has seen the same, like there's probably like 20 under perp dexes that haven't even been announced. Like there's literally like hundreds of them now, because of the opportunity that Hyperliquid created. And like obviously you get a little bit insecure when your price goes down. Competitive landscape has increased so much. And then you're kind of like, if most of your net worth is in that investment, like, yeah, you get a little insecure. So I do understand it. I'm just not sure if it's actually like beneficial for them to be as aggressive as they have been, because sometimes, like, I think Tarun's argument of like, we just need to make things a little bit more transparent, and we need things to be done more fairly so that it's more welcoming for people to actually trust us in the future, I think is very valid. And I think this is one of the core criticism that I have against Hyperliquid, is that they have not been as transparent as they probably should be in some aspects. And because of that, they are opening some sort of an opportunity for other exchanges, for other perp dexes to try to be slightly more transparent and try to open up a little bit more. But like, obviously the argument is also like relatively clear too. They do that because if they open source everything and everything is out there, it's easier to attack them as well. It's easier to take advantage. So there's always two sides of the argument. But I guess like I do understand why they have been slightly more aggressive, but I do think that it's not as beneficial as they think it is recently.
I mean, Larry, be careful. You might be the next victim of the .HLs.
It's fine.
I mean,
So
I will say one thing, which is like, despite the negativeness of everyone kind of from that community, I do think they do fundamentally know that if you really are going to have all of these new assets like equity perps and all this stuff, right? Like, the reason people want equity perps is not because crypto degens are going to trade equity perps. The reason is that you want like users who trade equities in Robinhood to come to DeFi, right? And like, all I'm trying to say is like, if you want those users to come, you better not give them this tail risk where they will be like, I'm never coming back, right? Like, and I think that's the takeaway you should have, not like, oh yeah, flooding our bags. In fact, the fact that you were able to survive and like stay online, whereas like a lot of other perp sexes like went offline, like
Mike Leiter.
Yes, which look, disclosure, investor in Lighter, Drift, and like Own Hype, you know, it's like I'm not like really, I kind of just believe in the category overall, and like I'm not trying to FUD anyone or not. I'm just like, we want this category to be as big as centralized exchanges and bring in the Robinhood users. You can't have 10-10 happen frequently. Like that's just like a fundamental truth, right?
So you touch on something which is pretty interesting, which is like, you know, you're bullish on the category. Another thing I was talking to with Larry before you hopped on was like, you know, just the way you invest, right? And like your investment species, robot ventures, you're always like very technical. I'd say argue more technical than the majority of VCs and builders in crypto. I'd love to hear a bit more about like what you're excited for in the next 24 months. You don't have to show particular bags, but like what are the verticals you think are going to 10x? What are the categories that you think are slept on? What's you know, it's like satisfying your you know, curiosity these days?
Yeah, I think there's a lot of stuff where, you know, everyone kind of talks about this like natural divide between like the vibe from token traders is horrible and the vibe from everyone who works on like stablecoin, neobank, whatever adjacent stuff like the Tempos of the world is very high, right? It's like they're like, oh, there's like everyone just constantly keeps asking how to make new stablecoins, and then the others, and like the question is like, what is the synthesis of those two? Like, where is the like middle ground between those two? Right? Like, obviously, DeFi is one area where that will inevitably be true, and like maybe it's equity perps, maybe it's earn vaults, earn programs. Like, there's this whole spectrum of things, but there's a question of like, what is the thing that's missing? And the thing I still feel like is kind of, you know, historically, it's always been really bad to invest in like front ends and wallets and like end user interfaces. But then there's always these gems, right? There's like Phantom, there's like an Axiom type trading terminal, you know, Pump. And so I guess like I'm currently just in the space of thinking about like what interfaces are the non-degens going to use, and like what is the non-degen interface? Because I think we obviously know what the degen one is, but I'm like, Robinhood has equity perps. What does that look like? What would like a competing version of that has a different growth strategy? Maybe it's like non-US equity perps users, and it just wraps that and like doesn't show any crypto or something like that. So I've been thinking a lot about the normie interfaces because I think the last few years, probably the best application, not infrastructure investments, were these interfaces that were like increasing their degen score, right? But I think kind of like maybe we're going around the corner. And so I'm thinking a lot about that. And I don't have any concrete answers. So I don't have anything to like say like, oh, I think this thing is like clearly the way it will happen. But I do feel like there's a lot of really interesting, but not like interesting to researchers or technical people, interesting stuff that's happened on like the embedded wallet side and like the MPC side, and that is like making the UX feel just close enough. And I think obviously, Privy sort of started that kind of part of the world, but now I think it's like you're starting to see more versions of this, especially things that are more, like Turnkey has a lot of interesting use cases for other chains. And these things are all things where it's like there's some established technology, but they're packaged it in the right way that it is useful for end users, as opposed to just being like, here's my MPC chain, like join it
Yeah.
or like run a node, right? And I think that's another area where I'm like, what are infrastructure technologies that people have maybe over invested in as crypto networks, but are actually going to be good as equity companies for Web 2 normie people? So I'm really focused on like normie users coming in. That's like the
Yeah.
TLDR.
One last question I have for you, Tarun, is like I think you double clicked on a really important thing, which is user interfaces and user experience has improved drastically. I've seen this as well over the last 5 years. It's like investing on Echo, for example. It's so simple. Like starting an Infinex wallet. Like it's getting to a point where it's very approachable. Now, then you also have something like a Poly market, right, where it abstracts crypto so much that most people don't even know that there is crypto, right? They're depositing something, but it's like so simple that it ends up having no effect on the underlying chain, right? So Poly market still uses a Polygon, and Polygon has been a chain or L1/L2 that effectively no one has talked about over the last 2 years, and even despite the success of Poly market, Polygon has gotten no attention whatsoever in the last year, as far as I can tell. Do you think this is kind of like an inevitable thing that will happen in the next few years, where we have these applications layers like Polymarket, like Hyperliquid, where it just doesn't matter what it's built on, and it doesn't actually, make much money for the underlying infrastructure? And is that something that we want to happen?
Yeah, that's a good question. So I'm going to reason by analogy so Kyle Samani can assassinate me because he doesn't like it. But and obviously, I think if there's anyone who's good at these, like I'm fully going in contrarian, it's him. So hopefully this analogy is not too bad. But I think about the .com bubble and like all these infrastructure companies that raised at huge valuations into like 1999, and like there's tons of companies that made data centers, tons of companies that were like making like there were companies that were doing like plumbing for data centers that were like trading at like 120x revenue in 99. And like actually right now you're seeing the same kind of these like weird companies, micro cap companies that are trading at crazy valuations. But an interesting thing is like after the .com crash, a lot of those companies got like rolled up, aggregated, and then eventually people like Amazon, when they started AWS, started like accumulating these companies. And there was sort of a sense in which whichever brand can persist through the crash and like have enough revenue to aggregate, I think is going to be the winner. And so in crypto, that's kind of hard to say, right? Because there's not like I can aggregate by the tokens or whatever. But there is a version in which you could imagine M&A where like enough of these infrastructure providers merge together and like offer this sort of more packaged service. And this is sort of why I was talking about infrastructure that's was built as a network, but now people want to buy it in equity form. And I kind of think that is actually what you might see. I don't know if it's going to be like the Santiago version of the world where like you have to buy a company and do PE style stuff, or if it's going to be like these networks naturally emerge. Like that part, I don't know how that happens. But I do think there's a lot of fragmentation in infrastructure, and there's a world where you could imagine that there's accumulation where like networks start merging and then offer bundled services until it they actually get higher value from their users. So just something in my mind.
Yeah, I just want to circle back on one thing you said, which is just like, what's like the non-degen interface? This is something I'm also unbelievably bullish on. I think that like, it's so fascinating because Phantom's great. We all love Phantom, 100% for sure. But I also think like a lot of what Phantom's doing now is what excites me, right? Like they did this
debit card?
hyperliquid. Yeah, the debit card is cool, but what I actually find cool is the hyperliquid integration and then the design choices they made about telling their users, right? Because what we're seeing is Phantom is approaching a level of automation where, hey, you have this front end, you can't even tell it's hyperliquid. You say you want to trade a perp, and then it'll literally do all of these things, come deposit this capital into Hypecore on your behalf without you even knowing. And it does it in a very seamless UX, right? Like these engineering questions were solved for a couple of years ago. But I think us as an industry, we did not feel comfortable as wallets, as front ends, for abstracting away this level of complexity from the user, right? Our user base was, I love crypto, non-custodial. I want to see all of this, like, frankly, irrelevant bullshit on my front end because I need to know. And what we're doing now is we're saying, hey, let's turn 10 clicks into 2 clicks. And let's not even tell the user what they're really doing, right? Like the user gives us these permissions because they trust us ultimately as a wallet. And we will create a level of automation that just makes things really pleasant. We're seeing this obviously with perps and Phantom. We're seeing this with Kahaku. The EF basically built like a privacy wallet SDK thing. And it's so obvious that like you take that and you just go like 5 steps further than what the EF would feel comfortable doing. And you now have a killer wallet with that privacy feature baked into it natively. So yeah, I'm unbelievably excited for these interface front ends as well. It's the era of the operating system is what I'm going to say. That meme is coming back.
All right. Well, now I know that Mega has changed its name to Mega OS.
What are you talking about?
I'm kidding.
Dude, now I have no announcement. God damn it.
Well, with that said, Tarun, thanks you so much for joining the conversation. This has been great. We call this the Big Brain Podcast. I think you're one of the people who are very deservedly on it. So thank you very much for joining.
Hey, thanks for having me. I'm letting me monologue for so long.